Okay, so in this video, I'm going to talk about a little bit of some details pertaining to underwriting for life insurance. So when you're looking at underwriting for life insurance, the basic idea here is this is the process by which the insurance company is attempting to determine sort of the risks associated with the death of the insured person, and therefore the cost associated with the policy that they're trying to buy. So what they should charge for it. And so when they're doing that, basically the life insurance company is looking at the pool of all the people they are insuring. They're looking at the risks of sort of the pool as a whole, but also things that are characteristics unique to each insured individual. And they're trying to assess the risk profile associated with the individual and what the probability is that the individual will die during the insured period. So when that occurs, there are a couple of factors that are often in play. So oftentimes, particularly if you start getting anything over a very minimal life insurance policy, very commonly what will be required is some sort of a medical exam, possibly lab work, where they do a blood draw and do lab work. They may want access to medical records, all those kinds of things. Basically, they're trying to get a sense for, what kind of state of health are you in? Obviously, the life insurance company is not going to want to issue a life insurance policy on somebody that has terminal cancer and will be dying in the next year. Because if you think about that from the insurance policy or insurance company standpoint, the probability is virtually 100%, and therefore they would need to charge you premiums pretty much equal to whatever the payout's going to be in in a couple months, and so that's not really going to make any sense. So from that perspective, they're going to look at possibly doing a medical exam, looking at medical records. They might do lab work, have you fill out more details and so forth. And that's where we start to kind of segue into another category that is important for the underwriting for life insurance policies. And that's sort of a general assessment of risk factors. And so that would mean that they're going to be interested in other information about you. Do you have a bunch of speeding tickets, which would put you at elevated risk for perhaps nastier car accidents? Car accidents tend to get dramatically worse the faster you are going when you are in a car accident. And that's basically just due to physics. So if you have a whole slew of speeding tickets, it makes the insurance company think that you tend to drive fast a lot, which means that the odds are worse that you're going to die in a car accident. They would also be interested in things like hobbies you might have. If you have any hobbies like spelunking or skydiving or things like that, that might actually involve some elevated risks of death. What kind of job you have would matter. If you are, for instance, a university professor, generally speaking, you wouldn't expect to have much of a mortality risk associated with that profession. If you are perhaps an offshore oil rig worker, there might be a bit of a higher risk there. If you work in construction, there's a higher risk that something falls off of a building that's in progress, lands on your head, and kills you, right? Whereas you just wouldn't expect to have that kind of a risk for somebody who's a university professor. So, what kinds of jobs you have, what kinds of hobbies you have, what kinds of driving record you have, things like that will all be important to the insurance company to try to assess what is the risk that the insured individual is going to die during the insured period. And the higher the risk that the insured person is going to die, the more expensive the policy is going to get. So, if you smoke, that it comes with elevated risks of lung cancer and things like that. So if you engage in riskier behaviors generally, again, higher risk of bad health outcomes that could ultimately result in premature death and so on. So when underwriting a life insurance policy, the life insurance company is trying to gather as much information as they can about factors that would relate to your probability of death. And then they're going to try to price the insurance policy relative to that, so that given their estimated probability of your death and given what you're paying, and across all of the insurance policies that they're doing. The idea is that they will collect enough money in premiums to pay for the payouts of those individuals who die and when they die, while leaving the insurance company with some money left over to compensate them for the risks that they've taken and the money that they invested in making this possible. Okay, hopefully that gives you a little bit of an idea about some of the things that insurance companies are looking at when underwriting life insurance policies. And thank you for watching, and have a great day.